It has never been easier to launch an AI startup. You can go from an idea to getting paying customers in a few days with tools that didn't exist even 2 years ago. But when you look at the actual economics of most AI startups, most of them are losing money in ways that they don't even realize. Now, you might be thinking that your numbers look fine. You have users, revenue, and maybe just raised a round. That is exactly what the founders at Builder.ai thought before they filed for bankruptcy with $445 million raised. Same with 𝐬𝐮 at $241 million. The problem was not the product. It was that nobody could see where the money was actually going until it was too late. We looked at over 100 AI companies to figure out what separates the ones that make it from the ones that run out of money. In this video, I'm going to show you 3 things. First, how to build a business where you always know your numbers. Second, how you can catch small problems before they become big ones. And third, how you can start to raise because you want to instead of because you have to. Most founders look at competitors, they see what they charge, and they price a little lower to win deals. And this feels safe, it feels intuitive, it feels like a smart way to get customers. It's not. When you price too low, you attract the worst possible customers. Price shoppers. The people who signed up because you're cheap. Surprise, they churn the moment that something cheaper shows up. And with AI, something cheaper almost always will show up. Recent data shows that AI startups have gross margins of just 25 to 60% compared to 70 to 90% for traditional SaaS. More money did not fix their fundamentals. It actually made things worse because they never had to get the pricing right. Here's what actually happens when you underprice. First, your feedback gets polluted. Start building for users who do not actually value what you do, but what they want you to do. You lose money on each customer, and growing faster means you just lose money faster. Basically, you train your market to expect cheap. And raising prices later is almost impossible without losing everyone who signed up for the discount in the first place. Here's a case study, Builder.ai. Builder.ai raised $445 million to build an AI-powered app development platform. It's a lot of words, but their strategy was basically, we're going to price aggressively low to grab market share. And it worked. They got customers, but those customers were very small clients who did not value what Builder.ai was actually building. The feedback was skewed towards price complaints instead of product needs. There was high churn from misalignment, operational strain from serving the wrong customers, and they couldn't sustain margins because they were stuck serving people who only cared about cheap. They filed for bankruptcy in May 2025 after burning through their cash. The product was super interesting. The economics never worked. Here's a simple framework. Calculate value you create. Time saved, revenue generated, costs avoided. Price at 10 to 20% of that value, and if nobody pushes back, you're too cheap. If you lose every deal on price, wrong customers, goal is not more revenue, it's better customers who stay. If you want to see how the fastest growing AI startups actually manage their cash, banking, and expenses in one place, check out the link in the description. It takes 2 minutes to set up, and you'll actually know where your money's going. Now that you understand pricing, there's another number that determines whether you survive long enough for any of it to matter. Long payback cycles. Payback period is the number of months it takes to recover what you spent acquiring a customer. Most founders ignore this number completely. They assume growth covers costs. Revenue goes up, problems go away. But long payback cycles actually mean you're bleeding cash on every new customer for months before seeing any returns. The 2025 benchmarks say ideal payback is 12 to 15 months. The average in startup land is 20 to 30 months, and inefficient companies hit 36 to 48 months. And here's what most founders miss. AI companies underestimate their true customer acquisition cost by like 30 to 50%. That means your payback period is probably longer than you think. When payback takes too long, you run out of cash before customers pay for themselves. You basically need to keep funding customer acquisition with money you definitely don't have. You can't reinvest in the product, you can't hire, and every new customer costs you money before they start making you money. Here's another case study of a hot AI startup, Cursor. Cursor raised over $100 million for their AI coding assistant. Then they discovered inference whales. Heavy users were costing up to $35,000 a month in tokens while paying $200 for a subscription. Cost per query exploded with usage. And it's driven negative unit economics, 20 to 200% margins underwater. And they had to apologize for pricing changes and are still struggling to balance costs. And finally, Anthropic. Anthropic raised billions, including $13 billion in 2025. Even at that scale, they posted negative 94 to 109% gross margins in 2024. $5.3 billion in losses. They were acquiring capabilities they could not afford to maintain long term. If a company that raised $13 billion is struggling with unit economics, what does that mean for a seed stage startup? Here's the framework. Track payback monthly. CAC divided by ARR per customer times gross margin. Aim for under 12 months. Over 16 months is when you're in the danger zone. Cut CAC by focusing channels or boost revenue through upsells. Do not scale until the payback math makes sense. Now here's the part most founders get completely wrong when trying to cut acquisition costs. Most founders try to get customers something like this. First, they post on LinkedIn 3 times a week, they run some Google ads, They send cold emails from a purchase list, they launch on Product Hunt, hire a part-time salesperson, maybe they sponsor podcasts or go to conferences. Then they wonder why nothing converts. And the reason is they're spreading themselves too thin. When you spread across that many channels, you never actually get data from any single one to know if it works. So everything runs at 20%. Data shows that 13% of startup failures come from poor marketing. Another 29% failed from cash burnout tied to overspending on acquisition. AI startups burning $100 million in 3 years, double the previous pace. And the pattern is very clear. Scattered GTM kills companies. Here's the case study. 𝐬𝐮𝐬𝐜𝐫𝐷 raised $241 for their AI hardware device. There was a huge amount of buzz from broad marketing and hype cycle pushes. I saw it on Twitter for weeks. They burned through their funding without focused acquisition. Aggressive sales, but device glitches delayed value delivery, and they had a lot of operational strain. They ended up shutting down in February 2025 with massive layoffs. They tried to be everywhere instead of dominating one channel. Rain AI is another example. They raised $200 million for AI chips. Broad GTM with big spends on marketing and partnerships without focus, but they struggled with prototyping while investor enthusiasm waned. No consistent channel dominance. Now they're surviving on bridge financing while seeking a buyer in 2025. Here's a framework. Find one channel, go all in until it works or dies. Only then expand. There are 3 questions you should generally ask yourself. First, where does your buyer already spend time? What's your unfair advantage? For example, if you're a technical founder, that may mean content. If you have sales background, that may mean that you are better at outbound. And finally, can you commit to 3 to 6 months? Most channels need that long to show results. Just pick one, go deep, and measure everything. And once you start getting customers from that channel, you need to know if you're actually making money. And that's where most founders completely lose track. Last lesson, margins determine who pays you. Payback cycles determine whether you can afford to acquire them. Go to market determines how fast you grow. You need that operational visibility, and it determines whether you survive long enough for any of it to matter. This is the one that founders skip. It feels like accounting, back office support, something to figure out once you have a finance team. But that thinking is why 38% of startups fail from running out of cash. 82% of small business failures tie back to cash flow problems. The product was fine, the market maybe was there, they just didn't know where the money was going. For example, with AI companies, their average burn rate is double that of non-AI companies, with a 90% failure rate. That's super important, and a big reason why you should understand this concept. Case study Stability AI, they raised over $200 million for AI image generation. Then came the surprise. $99 million in cloud bills they couldn't sustain. The reserves dropped to around $4 million while they owed money to US, Google Cloud, and CoreWeave, and there was just operational chaos from rapid expansion. Nearing collapse, leadership changes, and cash problems along the way, and they just kept bouncing between problems without fully fixing any of them. Another example, CoreWeave. Even well-funded players like this, they're not immune. They've raised over $14 billion in debt and equity, and they have massive cash visibility issues. $20 billion in annual spend versus $5 billion in revenue. Surprise obligations from complex financing created chaos. If a company that raised $14 billion can have cash visibility nightmares, so can you. The pattern is always the same. Small leaks become big leaks, and by the time you even notice, you're already underwater. Here's the framework, your default alive test. If revenue keeps growing at the current rate and expenses stay the same, do you hit profitability before cash runs out? Runway formula. Cash balance divided by monthly burn. Know this number at all times. Average seed stage burn is about $50,000 to $150,000 per month. Here are 3 things that founders who win actually do. First, they have one place for all their money movement, not 4 bank accounts, not 3 credit cards on a spreadsheet. They have real-time visibility by category, payroll, software, contractors, marketing, and they automate the boring stuff. No reconciling receipts at midnight. This is not accounting. It's knowing what is happening fast enough to make good decisions. Companies that get this right catch problems early, they fix small issues before they become big ones, and when they raise, they do it because they want to, not because they have to. The AI startups that fail have bad economics. They have weak pricing that attracts customers who churn. Long payback cycles mean that every new customer puts you deeper in the hole. And scattered GTM spend means no channel ever works well enough to scale, or for you to even know if it's working. If you cannot see where your money's going, small problems become big ones before you even notice. And the companies that make it audit all 4 of these things very early before growth locks in the damage. You might be thinking that you will figure out the finance stuff later. You're busy building products, you're talking to customers, but if you want one place for your banking, cards, and expenses so you actually know where your money's going, check out 𝐸 in the description. The difference between a promising product and a healthy business really just comes down to catching these problems early. If you get it right, and fundraising becomes optional.